Topic 4 on private equity covers 2 readings, one on private equity assets and one on private equity funds. So we start with 4.1. So the categories of private equity assets that we focus on are venture capital, growth equity, and buyouts. And then obviously here they're just being introduced, and then we talk about them in more detail in the reading. But essentially, you know that venture capital is providing equity financing for startups. They occur in sort of the launch phase or early phases of the business cycle of the company, and obviously can overlap a little bit into the early growth stage as well. And then growth equity is focusing in that growth life cycle stage. And as you can see, of course, all these categories kind of can overlap in their end and beginning periods. And they basically take a non-controlling interest in the companies. And buyouts, in contrast, take a control interest in companies, and they're engaging in companies in their mature stages, right? So it's sort of that end period here. All right, and then remember that venture capital, given that it's a risky investment in the early stages of a startup, has a payoff that represents a long call option. So nice hockey stick shape that we're very comfortable with at this point. Limited downside, which reflects the investment they put in that they may lose, and then of course potentially significant upside. All right, and then the different type of private equity funds that can be established based on those assets. So buyout, again, growth equity and venture capital. I think you should know some of the details of this, approximately how many portfolio companies are included in a buyout fund. For example, relative to a venture capital fund, that due to the underlying risks of, investing in startups, they tend to invest in a lot more portfolio companies, or often really referred to as startups. And therefore, these funds are much more diversified, for example, than a buyout. So they invest a little bit, but in a lot of different investments, just because there is a large loss rate. And then remember that private equity funds provide intermediation with respect to risk. They assume the risk of those underlying private funds and provide limited liability to their LPs. And also what we term here as efficient incentives, meaning that basically they align the interests of they provide incentives for those interests between managers and shareholders to be aligned, which ultimately results in higher returns and greater efficiency. And then, of course, we want to know what the primary functions of these funds are, from pooling capital to, due diligence, screening, selecting companies, private companies, etc. And remember, with any list or any kind of, some discussion where there's a series of things, the CAIA Association can give you a few of them and then ask you for the remaining or ask you for some of the others. It kind of, it makes it a bit more challenging, right? Because you may not remember some of them, you may remember the ones they gave you. So they might say, other than financing, financing companies, let's say venture capital startups, and monitoring and coaching them, what other functions, what are the other primary functions of private equity venture capital funds, or any private equity